Hi, John Defoes from Forbes here. Welcome, Facebook Live viewers. We're at the Money Show San Francisco, talking to Peter Schiff from Euro Pacific Capital.
Yes.
Remember you back in the day? We were talking about the Fed. This is when Greenspan was still in office.
Yeah, back then I was talking about the financial crisis that was coming. I was talking about how the Fed's mistakes had inflated a real estate bubble and how when it pops, we would have the worst recession since the Great Depression. I was predicting double-digit unemployment and trillion-dollar deficits. I was predicting the bankruptcy of Fannie Mae and Freddie Mac, and of course, all that stuff happened.
And you were predicting the Cubs would win the World Series too. And you called me in the third quarter of the Super Bowl too, and you told me the Patriots were actually going to win last year.
Now look, I did think the Patriots were going to pull that one off. So, but this is more important than
football,
because the reality is, the problems that I saw leading up to the 2008 financial crisis are dwarfed by the problems that we have now. The monetary mistakes that have been made under Bernake and Yellen are much larger than the mistakes that Greenspan made. So the problems they have created, the bubble that they have inflated, is far bigger. And so what happened in 08, that's nothing compared to what's about to happen. And unfortunately, this thing is probably going to blow up on Donald Trump. And I wish he hadn't claimed ownership. You know, he put his brand on this stock market bubble, on this phony economy, and this thing is going down in a big way. They're going to have to rename the Great Recession because this one is going to be worse, and we're still going to be in it when Trump's up for re-election. But we are going to have a dollar crisis this time. It's not going to be a garden variety financial crisis. See, that was nothing compared to a currency crisis when the dollar is what's under collapse, when people are running away from treasuries, not just mortgage-backed securities, but when the U.S. Treasury bond market is imploding because of a loss of confidence in our ability to pay our debts, right, which is long overdue. It's a totally different story. And the average American is going to suffer much more this time. But also, there's a much bigger potential for the average investor. That's why I'm here at the Money Show, to try to show people how to profit from the events that are about to unfold.
You know, last time there was a flight to safety, and back in those days, like I'm talking about 2008, 2009, the flight to safety was into the U.S. bond market and into the U.S. dollar. So the dollar did not collapse.
Right.
But we've got, what, about a doubling of the national debt? More than that. We're up to 20 trillion now. I think we had like 8.5 trillion back then.
This time it's going to be a flight to safety, but it's going to be a flight from the dollar, from treasuries, because people are going to realize that there is no safety there. And so the next safe haven is going to be gold, right? And it's going to be certain other foreign currencies where the governments are in much better fiscal shape, or the economies are in much better shape. These are creditor nations, countries that export rather than import, that save rather than borrow. So you're going to see a redefinition of what is a safe haven and what is a risk asset.
Right.
Because the dollar is going to go from being a safe asset to being a risk asset, in fact, from being the riskiest asset, and people are going to be getting rid of them as quick as they can.
We're going to talk in a minute about what to do specifically if this scenario transpires with Peter Schiff. Come on back. You know, you get to a lot of philosophical questions.
Next few minutes. Speed. Okay, stand by. Let me get this one here. And 3, 2.
Hi, John Defoes at the San Francisco Money Show here. I'm from Forbes. I'm with Peter Schiff. He's from Euro Pacific Capital. Peter's been an outspoken proponent of a basically wrecked economy.
Well, I'm
not proponent. You argue why it could happen, though.
Right. Well, I just call it like I see it. I'm not, caught up in all this hype and propaganda that comes out of Washington or Wall Street. We are in a lot of trouble. Donald Trump was right when he was a candidate. This is a big, fat, ugly bubble. The economy is a disaster. The difference is it hasn't gotten any better since Trump was elected. It's the same economy. It's the same phony numbers. It's the same bubble. And unfortunately, it's going to pop under his watch.
So if that does happen, if it does pop, if people lose confidence globally in the dollar as a riskless asset, where are they going to put their hard-earned money?
Well, some of that hard-earned money is
or,
just going to evaporate into money heaven, because as the dollar plunges, right, people who have dollars, by the time they sell, they're going to get fewer euros or
whatever,
fewer yen or fewer ounces of gold. But people are going to pull their money out of U.S. assets, and they're going to recognize America for what it is. Right? It's not this safe haven. We're not credit worthy. We're really like a banana republic. Our debt is junk bonds. People just don't, connect the dots that should be rather obvious.
Why hasn't it happened yet, though? You know what I mean? We've got 20 trillion in debt. We've got receipts of about $3 trillion a year. Why hasn't the collapse come yet? And what will the trigger be?
People were saying that to me about the housing market. Peter, you've been talking about this bubble for years. Why haven't it collapsed? Bubbles get bigger than you think.
That's
but
true.
Eventually they pop and the air comes out. And so why is it taking so long? I don't know. Usually the bigger they are, the longer it takes to pop. I mean, the whole world is caught up in this hysteria. And, they've been able to keep interest rates artificially low, but eventually they're going to lose control. Eventually interest rates are going to go up, and that's going to expose the farce because we can't pay when interest rates go up. We're too broke.
No.
We can barely afford to pay now. In fact, we can't afford to pay now because the U.S. government has to borrow the money to pay the interest on the money it's already borrowed. But if the interest rate goes up, then that's it. The party's over. But before that party ends, you got to get your portfolio in order.
What would you do then to protect yourself now before this rush out of the dollar happens that you think might happen?
You got to invest in foreign stocks. Look at emerging markets are crushing it this year, more than double the return on the S&P, and they're still cheap. So there's a lot of economies that are going to benefit from a weak dollar. Also, developed markets. If you like bonds, fine, but don't buy bonds of the United States. Maybe look at Singapore. Look at New Zealand. Keep your maturity short because the rates are still low globally. But you got to get out of the dollar. You got to own gold. Gold stocks are dirt cheap. Even though they're up quite a bit last year and they're up again this year, compared to the price of gold, they're historically cheap. A lot of money's going to be made by people who buy these stocks. Very few people own them now, which is another reason that they're so cheap. But you need to be smart.
Gold needs to get up 50% to get to where it was in 2012 when it peaked, right?
Well, remember, it went from under $300 an ounce in
Sure.
2000 up to $1,900. And then it pulled back, and now we're around $1,285, $1,290. We corrected. We built a great base for the last few years. Once we take out $1,300, $1,350, but maybe $1,300, we're off to the races.
Yeah.
It'll move quick. If you're not on board by then, you may never get on board. So just buy now. Don't wait for the stampede.
Peter, thanks a lot.